Welcome to Shareholder Primacy from Free Float Media, a podcast about activist investing, securities law, and all the ways the financial and legal worlds intersect and collide in real life. I'm here with Ann Lipton, law professor at Tulane in New Orleans, who teaches and researches securities and business law. She holds up the legal end of our little podcast here.
And that's Mike Levin, an activist investor who lives and works in Chicago. He covers the financial side of our podcast.
Terrific. What should we talk about? You want to talk about the interesting stuff that happened to Ben & Jerry's this week? How's that sound, Ann?
That sounds great. And we should also look at how shareholders can buy and sell votes and a recent effort to create a marketplace for votes.
Right, the late, great shareholder vote exchange. But let's get started with little Ben & Jerry's action. How about it? Okay. And my question there is... you eat Ben & Jerry's, right? You like it?
Sometimes.
What's your favorite?
Well, my favorite is a discontinued one. It was a chocolate and peanut butter. It was like peanut butter cookie dough and chocolate ice cream, and I don't think they have it anymore. I'm
a weirdo. I happen to like, they have a banana one called Chunky Monkey. Mm-hmm. That's a little weird, but I love it. So, but we haven't had Ben & Jerry's here for a while. There's other ice cream we tend to eat, but... in their honor, we'll talk about their recent corporate governance case.
Yes.
Because there were some headlines this week. Well, there have been headlines for a couple of years about the weird relationship between Ben & Jerry's and its corporate parent, Unilever. But let's talk about the lawsuit this week or last week that Ben & Jerry's filed against Unilever, which is a little unusual because Ben & Jerry's is wholly owned by Unilever.
Yes.
In other words, Ben & Jerry's has a single shareholder, and it's not Ben & Jerry anymore. And that shareholder is Unilever, the global food product corporation. So let's figure out what's going on here, and in fact, how can a wholly owned sub sue its parent? And we'll talk about why they sued it and what the prospects for that. I would have thought that the parent would have kind of objected to the subsidiary suing them, but that's just me, and I'm not a lawyer. So, go ahead.
Well, they do object, but the thing is that they're objecting in court, which is not usually how a parent goes about controlling its subsidiary. So, the story in this case begins in 1978 when Ben Cohen and Jerry Greenfield founded Ben & Jerry's, the ice cream company, which is
in Vermont.
In Vermont, not in Delaware.
Right. And is it still incorporated in Vermont?
It is still incorporated in Vermont, actually.
No kidding.
So they were these Vermont hippie types, and they ran the company with this social conscience. And they continued to do that even after the company went public because it had this dual-class share structure that gave Cohen and Greenfield the controlling votes. So in 2000, they decided to sell the entire company to Unilever for cash. So everyone's going to be cashed out. But Cohen and Greenfield, who held these high vote shares, and they were therefore in control of whether or not a deal went through, apparently they didn't want to sell their company unless they got some reassurance that the Ben & Jerry's social mission would continue. So Unilever agreed to what, as far as I can tell, is a unique arrangement. The merger converted Ben & Jerry's into a Vermont close corporation with a single shareholder, Unilever. I mean, well, actually, it's Unilever's American subsidiary, but it's basically Unilever's the only shareholder. And then, as the sole shareholder, Unilever signed a shareholder agreement with Ben & Jerry's, the company it now completely owns. It signs a shareholder agreement with its own company, the subsidiary, Ben & Jerry's. And the agreement provides, so there are only two parties to this agreement, Unilever and its wholly owned subsidiary, Ben & Jerry's. And the agreement provides...
Unilever and Unilever, kind of.
Exactly. So the agreement provides that the directors who were in office at the time of the merger, the ones that Cohen and Greenfield selected, they will remain directors after Unilever takes over. Unilever gets additional directors, but a majority of the board are these continuing directors, and the continuing directors get to pick their own successors. Unilever agrees. It promises that the continuing directors get to pick who's going to succeed them, and Unilever, as shareholder, has to vote to put them in office. And then the agreement says that, Unilever, it doesn't control the board now because it agreed to allow the directors to pick their own successors, but Unilever gets to pick the CEO. And the CEO, according to this shareholder agreement, has operational control over the company, but the independent board members remain in control of the company's social mission. So that's how Ben & Jerry's, now this wholly owned subsidiary of Unilever, can end up suing Unilever. The board that makes decisions on behalf of Ben and Jerry's is answerable to no one, not even the sole shareholder of the company.
Right. Well, it's answerable to its predecessor directors, I
no,
guess,
it's not
way.
answerable
Okay,
to anyone.
not even to them. Okay, fine.
I mean, the predecessor directors selected them, but they're gone, so it's not answerable to anyone.
Now, were Ben and Jerry were they the directors at any point of this in this structure? Do we know?
I assume they. I don't know if they were after the takeover or not, but they're not on the board now.
No, absolutely not now. They've moved on.
Yeah.
All right. So that's the structure that we have in place. Let's ask, I think, about the lawsuit. Is that a good thing to talk about for a minute?
Yeah. I mean, just another point though that's worth mentioning is that if Unilever breaches this contract, like if Unilever says,
the governance contract.
Yeah,
go ahead, yes.
like the governance contract. If Unilever says, one day I don't want to select these directors, the interesting thing is who has the enforcement rights if Unilever, which is what leads into this lawsuit, who has the enforcement rights if Unilever breaches this contract? Ben Cohen and Jerry Greenfield are the original founders of the company, but they don't have any enforcement rights. They clearly wanted this arrangement. Presumably, the only reason they were agreeing to sell was if the company arranged for this social responsibility mission. So you'd think the normal thing would be the contract would say something like, Unilever is obligated to continue the social mission, and if they don't, Ben Cohen and Jerry Greenfield get to continue. Or it could say Ben Cohen and Jerry Greenfield get to appoint continuing directors, and they could sue if Unilever. That's what you'd expect the contract to say, but it's actually not what happened. The contract, as I said, is really and truly only between Unilever and the wholly owned subsidiary, this new version of Ben and Jerry's. And the contract says there are no third-party beneficiaries. This contract is not for the personal benefit of Cohen and Greenfield. It's not for the personal benefit of the directors or for the personal benefit of the original shareholders. The only beneficiaries to this contract are Unilever and Ben and Jerry's, its wholly owned subsidiary. So if there's a breach, if Unilever is apparently not living up to its obligations, Ben and Jerry's, under the control of this independent board, can sue to force Unilever to perform its obligations. And if Unilever refuses to cast its votes as a shareholder for one of the directors that this new continuing board wants, then that director and the board can sue. So that's how we end up in this lawsuit situation. Ben and Jerry's suing to say, Unilever, you breached your shareholder agreement. You breached your arrangement.
All right. And there's this written agreement that gives the governance rights basically to the sub.
To the sub, to the extent it deals with the social mission.
Yeah, right, to social mission, right. So the scope of this shareholder agreement probably doesn't have to do with like budgets.
No, that's the part that's allocated to Unilever.
Right. Okay. So then who sued who over what where?
Okay. Well, there's a new lawsuit that's in the headlines, but it's actually a continuation of a dispute that dates back to 2022. So a couple of years ago, the independent board of Ben & Jerry's, the social responsibility arm, decided it wanted to halt all sales in the Israeli-occupied territories because obviously they objected to
sales of Ben & Jerry ice cream.
Sales of the ice cream. They objected to how Israel was treating the occupants of the West Bank and Gaza. So in response to Ben & Jerry's saying, the board saying, you know what, we won't want to sell in the occupied territories, Unilever decided that what it would do was just spin off the West Bank aspects to a third-party distributor, let someone else sell, but that distributor would get to license all the Ben & Jerry's trademarks. And at that point, this independent board caused Ben & Jerry's to sue Unilever to halt the spin-off because the independent board didn't even want the trademarks to be used in the West Bank. So they wanted a preliminary injunction saying this is terrible. Unilever is violating its obligation to let us handle the social responsibility arm. So the board's argument was this is about social responsibility. We don't want to have our mark anywhere near the West Bank, and Unilever, by forcing our mark near the West Bank through this spinoff, is violating its aspect of the agreement that it's supposed to let us handle social responsibility. So they tried to get a preliminary injunction. The court refused to issue an injunction to halt the spinoff, and then after that, the parties reached a confidential settlement. We didn't hear anything more about it.
This is like 2 years ago.
This is 2 years ago. We didn't hear anything more about it. The parties settled this thing about the West Bank. We don't know what's going on until a few days ago when Ben & Jerry's again sues Unilever, and this time they argue, you're violating the settlement. So the settlement
interesting. Okay.
So the settlement is still actually mostly confidential. If you go and look what they filed in court, it's all blacked out except for like 2 provisions that are made that are unredacted so that we can see what they're suing over. So this is what the directors claim, the Ben & Jerry's directors claim Unilever is violating now in respect. So the problem, as far as we can tell, the settlement had Unilever. It had to make a promise that it would respect the independent board and its continue to respect the independent board and its responsibility for social mission, and also it had to agree to donate $5 million to humanitarian organizations that were selected by Ben & Jerry's, the board. Right. The problem, apparently, is that after the settlement was reached, Unilever appointed a new head of its ice cream segment. So there's that includes more than Ben & Jerry's. It includes Magnum, it includes some other brands. So there's this new guy who's in charge of ice cream, and he's fighting the settlement. He doesn't want Ben & Jerry's to issue statements in support of the Palestinians of Gaza. Oh, that's what they want to do. They issue statements. Right. He doesn't want the statements. And he doesn't want to let Ben & Jerry's donate $5 million to Palestinian causes, which were the humanitarian organizations that the board selected. So he blocked the board from taking action. And according to the complaint, he threatened to dissolve the independent board entirely. And that is why we have the second lawsuit saying that these actions violated the settlement.
Right, the settlement
agreement. Part of the first lawsuit.
Okay. So the way in which Unilever proposed originally to do this was to basically spin off the Israeli arm into a third party, which evidently happened.
And what the board had originally objected to was using the trademarks.
Right, exactly.
Which apparently, as far as we know, I haven't been to Israel to see, but I gather is still
it's there somewhere, right? You could go buy Ben & Jerry's in various places. And then the lawsuit in the past couple weeks alleged these violations of the settlement agreement that the new head of ice cream at Unilever Global wanted to do.
Exactly. Violation of the agreement by not letting them issue the statements, which is an interference with their social responsibility mission, and not allowing the donations to Palestinian causes, which is an interference with the promise to donate $5 million to humanitarian
Got it. So there's those kind of two kind of facts on the ground about the statements and the money. All right. So what, as you see it, because you're the lawyer, what are the legal issues?
Well, the legal issues, the most obvious ones are actually the most boring. And is this a breach of the agreement? Okay. So did Unilever, so the original lawsuit, remember the claim was using trademarks in the West Bank was an interference with the board's responsibility for the social mission. So there's a contract interpretation issue there. Is that a social mission issue or is that an operational issue? Because the operational issues are allocated to Unilever. So, and then we have this new settlement. We don't know the full facts. We know the board's interpretation of the facts. We only have 2 little blacked out segments, 2 little unredacted segments of the contract. Right. So, but so honestly, the boring question is, contractually speaking, if you look at this contract, did Unilever actually violate either one of the original shareholder agreement or the settlement?
Or the settlement agreement, right.
Right, but that's just a question of contract interpretation. What does the agreement require, and it is what it is. But that's not the interesting part. I don't care whether they violated the contract. What I care is, how do you even have a contract here? Because as you said, Unilever versus, this is Unilever making a contract with itself. And you're right. A contract has to be between 2 parties, at least 2 parties. But here, Unilever's contract, and this is audio, so the listeners can't see, but I just imagine scare quotes here. This is contract between Unilever and its wholly owned subsidiary. It's as though it made a contract with itself. It's the legal equivalent of me filing a lawsuit against myself for breaching a New Year's resolution. I mean, just conceptually.
Well, that'd be fun.
Exactly. The corporation it's just a legal construction. It's a fiction. It's a stand-in to represent the interests of the people who are involved with the company. And traditionally we'd say it represents the interests of its shareholders. And if the shareholders are institutions, then they represent the interests of their shareholders all the way down to the people. Where they have their duties and all that, right? Yeah, right. That's the doctrine of shareholder primacy. But in this case, there's only one shareholder, Unilever, and its interests are not being represented. And if this corporation is not being run for the shareholders, who is it being run for? Like, what real world living person is supposed to be the beneficiary of Ben & Jerry's that these directors are acting on behalf of? Now, we've talked about this before. Some people have argued corporations shouldn't just be run to advance shareholders' interests. They should be run to advance the interests of other stakeholders, the employees, the customers, and so forth. So on this theory, the corporation as a legal entity should act to advance the interests of these other groups. And that's fine, but that's not what's going on here either. The Ben & Jerry's board isn't claiming to advance the interests of its employees or its consumers, and it's certainly not beholden to the employees or the consumers.
No, not at all.
It's not advancing the interests of the founders, Ben & Jerry, because they're not parties to the contract, and they have no rights in the contract. The contract explicitly disclaims any obligations to third parties. So it's not clear which people the board of Ben & Jerry's is supposed to be representing. The current shareholders? No. The former shareholders? No. The employees? No. The customers? No. The board is beholden only to itself, using corporate resources to benefit the world, except benefiting the world in this case is entirely based on the board's own personal values, entirely unanswerable to anyone except themselves. I mean, the problem with that is the board members are not parties to this contract. Their interests aren't supposed to be represented. They have a fiduciary duty to advance someone's interests, but I have no idea who that someone is supposed to be, and they don't know who that someone is supposed to be. So this shareholder agreement, it's governed by New York law. And Ben & Jerry's itself is incorporated in Vermont. Now, I don't know what the quirks are of Vermont corporate law, and I don't think even Vermont knows the quirks of Vermont corporate law, quite frankly. But if this arrangement was gauged by Delaware standards, I think there'd be a real question whether there's an enforceable contract here, because the only real party with an interest, a legally protectable interest, is Unilever. And it does not want the Ben & Jerry's board to take these actions.
Right. Yeah, they want to continue. They don't think they breached any agreement.
Exactly.
So they want to continue to do what they were doing. In particular, this new ice cream head wants to do their thing.
Right. And so these are not, Unilever's interests are not being advanced, and I don't know who the board of Ben & Jerry's, what human people living in the real world whose interests they think they represent.
Wow. Now, do we have any idea why Unilever decided to do this in the first place? Why they even agreed to this kind of really weird ass structure? I think.
No, I can only assume they agreed in the first place because Cohen and Greenfield wouldn't sell otherwise. And I think Unilever gets, or used to get, some value out of the brand's reputation for social responsibility. I think it's part of the marketing. The brand is associated with this crunchy liberal politics, and that's kind of a draw for some customers. And here's the thing, which really highlights the bizarre nature of the arrangement. Unilever can nuke the whole thing at any time. Not only could it argue in court that the contract is unenforceable, and I think it has a strong argument, but the contract says it can be terminated if all the shareholders agree. But there is only one shareholder.
There's only one. The shareholder has to agree with itself.
So it can end this anytime it wants to. It's living in a hell of its own making.
Right.
As far as I can tell, it just doesn't want to.
I can't imagine what the ice cream head is. He probably's new or whatever.
No, I don't think it's. Yeah, he is new, but I think that's Unilever probably just doesn't want the headlines. I'm guessing that the complaint alleges that he threatened to disband the board. And I'm guessing that's what he said, look, the agreement says I can dissolve this agreement, and I will.
Why don't we just do that? Yeah, right.
Yeah. So we'll have to
I just want to sell ice cream. Yeah. Including in the West Bank.
We'll have to see how this unfolds because it's possible, I don't know because it's so hard to tell, it's possible the board is arguing that when Unilever agreed in 2022 to respect the board's authority, that somehow supersedes the termination right in the shareholder agreement. Maybe they're making that argument. I don't know. But beyond that, Unilever could argue in court the whole agreement is meaningless, or it could simply exercise its termination rights. But it hasn't chosen to do that. Now, the really interesting thing is that Unilever announced several months ago that it plans to spin off the entire ice cream business anyway. Ben and Jerry's.
Like in a separate corporation, outside of Unilever. They're getting out of ice cream.
Rid of it. They're getting out of the ice cream business, and they either want to make a whole new publicly traded entity that's ice cream, or they want to sell it to somebody.
Sell it to PE, private equity or something.
Yeah, right. Something like that. And I think one way or another, the shareholder agreement is going to be terminated as part of that process. But maybe Unilever wants to keep as much of the status quo as possible until that process is complete. So that might be part of the thinking as well, why they haven't just blown it all up.
Oh my God.
I know.
That's like existentially strange.
There is, though, this last puzzle, which is why did Ben and Jerry, like the original Ben and Jerry, want to do this in the first place? Why didn't they create a stronger contract? They could have. Like the normal thing would for them to say the contract is between them, Ben and Jerry, Ben Cohen and Jerry Greenfield. with
Yeah.
Unilever, we won't sell you the company unless you promise us that you will run your company this way. They could have done that. And the only
Right.
but they didn't. So I'm guessing. So the question is why? And I'm only guessing. But remember, the Ben and Jerry's company was publicly traded with dual class shares. Cohen and Greenfield held the high votes. They were the controllers. Now, I don't know about Vermont law. Again, I don't think Vermont knows about Vermont law. I don't know about Vermont law, but in Delaware, if a controller sells the company to a third party, but gets a side agreement, a benefit that is not shared with the minority, that creates a conflict transaction. And usually the issue is something like the buyer offers to pay the controller extra consideration. Like minority shareholders get $10 per share, but the controller gets $11 per share. That extra dollar going to the controller, that's money that might have gone to the minority. It's money the buyer was willing to pay, but because the controller is demanding extra, it's being siphoned away from the minority shareholders. In that situation, the controller is competing with the minority for consideration. It's what's happening right now in the sale of Paramount to Skydance. Shari Redstone is getting more for her shares than the public holders are getting. So that's considered a conflicted transaction, and as we've said several times on the show,
there's all sorts of levels of approval that are needed
if
there.
it's a conflicted transaction, if there's a shareholder lawsuit, it gets deep examination by the court. I mean, it becomes this whole big thing. So in the case of Ben and Jerry's, the founders didn't demand extra cash. They got the same consideration as everyone else. But if they had demanded a side promise of social responsibility to themselves
this
personally,
this governance provision.
Exactly, that would have been a unique benefit that presumably they were paying for in some way, perhaps with less consideration for the whole company. It makes the company less valuable. And if they had set it up as a personal promise, they've created a conflicted transaction. So suddenly the merger could have been subject to a shareholder lawsuit. So I think that by structuring it this way, not as a personal promise to Cohen and Greenfield, but as a promise to the company generally, that kind of took it out of the box of conflicted transactions.
It sort of smoothed the approval in 2000.
Back 2000 when the merger took place. I think that might have been.
So that's your guess at why Ben and Jerry, the people Ben and Jerry agreed to this.
Ben and Jerry, why they wanted this, and this is now where we are 24 years later.
Wow. All right. I need a little break so I can think about that, and I think we should take a break. And then return to some other less subtle subject. How's that sound?
Okay.
All right. Well, we're gonna take that break right now, and we'll return to this unexpected idea of buying and selling shareholder votes here at Shareholder Primacy.
This is the Free Flow Media Podcast Network, where we cover the who of the business news, because investing isn't a what, it's a who. Check out our other podcast, Business Pants, for fact-based snark covering companies and executives, and the Proxy Countdown, the only podcast that treats company meetings like sporting events. Find them on iTunes, Spotify, or wherever you get your podcasts. Back to the show.
Welcome back to Shareholder Primacy. I'm Ann Lipton here with Mike Levin. And I guess the question is, can shareholders really buy and sell votes? What's the idea behind this?
That's a really interesting question. It's been tried on and off, not very successfully over the many years and decades. But there is this overarching sort of economic theory. We'll talk about the legal stuff in a little while. That votes are this kind of asset, separate from the cash flows of the company. They have a value. There have been many scholarly efforts to try to estimate the value of votes. A friend of mine, Slava Foss at Boston College, has done a huge amount of work in trying to kind of calibrate or estimate what the cost of a vote should be.
Yeah, I'll actually add that it's an issue when there are lawsuits that voting rights were invaded, but you can't figure out what the financial result is.
Right. And so over the years, there's been a lot of thought put into, what are votes worth kind of apart from the basic assets of the company. They had, this idea had its, culminated a little bit in a little business that got off the ground barely last year and closed within a few months, called the Shareholder Vote Exchange. and I kind of knew the young guys who created it, and they were creating a marketplace, an actual place where you could offer cash for votes. Now, the question becomes, who would this be interesting to? Well,
Yeah.
it'd probably be interesting to activists. So instead of, or in addition to, trying to persuade other shareholders to kind of vote for my program, vote for my directors, shareholder vote exchange was going to facilitate the actual commerce in these votes. They were going to create a place where people who would not normally vote their shares, they would just kind of throw the proxy away, or they didn't care that deeply about it, where they could in exchange for a little bit of money sort of convey their voting right over to somebody else, and that somebody would be an activist like me. So again, instead of just trying to persuade another shareholder, like through my proxy solicitor, my case is better, my directors are superior, the current guys are bums.
Right.
Why don't you just say, okay, what's your vote worth? How much you want for it? And so shareholder vote exchange went and got a small number of, mostly I think retail shareholders, to kind of post their ownership and their votes on this little exchange, and they were trying to then find activists to then buy them, like in the middle of a proxy contest. And it only was trading for a few months. The volume was, I think, in the very low millions of dollars.
Right.
And they finally had to shut it down. But there was actually one other kind of, so to speak, use case that was being proposed, which was companies might find this interesting if they were having a problem like getting a quorum or trying to find shareholders to vote. So they were saying maybe we could compensate shareholders to attend a meeting and vote. Now that idea from the company side is actually done in some other way. So like there's plenty of public companies that offer kind of swag.
Yeah, I've seen that. To get the retail shareholders to vote, they'll plant a tree,
or they'll give you a tote bag or something.
Or
like
in
that.
Tesla's case, it was get a tour of the factory.
Yeah, get a tour of the factory, exactly.
When they were trying to get his compensation ratified.
Yeah, right. So there was sort of these two use cases. First, in a proxy contest, activists and potentially companies, we didn't talk about that, trying to compensate shareholders for their vote, or in a non-controversial but nonetheless situation, unusual situation where the company just, really is having a hard time finding shareholders or persuading them to, show up to an annual meeting. Maybe they could compensate them too. And then the shareholder vote exchange actually tried to do a little both. As I said, it didn't get very far. There was some market structure issues there that didn't work out well for them. So for a few months' time, it was kind of fun to follow, but didn't really go very far. So
I mean, are activists worried about the legality of this kind of thing? Or
that's something we should talk about. Whether it's in fact legal to buy and sell votes, it sort of depends, like everything in law. My read, and I think you've thought about this too, is that at least in Delaware, which is the only place I've studied this or looked at this, it is legal for one shareholder to convey its vote to another shareholder in exchange for money. Okay, there is nothing in Delaware law. Either there's nothing on the books there's no statute, and there's really nothing in case law that prevents or precludes one shareholder from selling its vote to another. And that actually, that makes some sense. You've seen shareholder agreements where, part of the consideration in a deal is to, to vote a certain way. So embedded in there is the idea that we're going to pay you for your vote, though the pricing on that is usually kind of opaque. Okay? So the legality of from one shareholder to another Delaware law is it were silent and probably very permissive here. And I don't know if you.
Well, it's a little bit vaguer because they have expressed concern if the consideration separates the economic interest from the shares. So there are all kinds of arrangements where, like, the promise of the vote is sort of in the expectation that this has something to do with the value of the shares. So the shareholder isn't really separating their economic, like, they haven't actually had, but there's been some concern that the consideration would be such that you've decoupled economic interest of the shares from the voting power. And that is, I can't say that they've made it clear that is a red line, but if there's a red line, it's something like that.
It's probably there.
Yeah, but if there is.
Right. Now we have to look at the case of, can companies compensate shareholders for their votes? And I think the answer is trending toward maybe not. Legally, that it's particularly companies can't use shareholder resources if particularly like in a proxy contest.
Yeah, they can't. Yeah.
So if it's something non-controversial, the second use case that shareholder vote exchange explored, just trying to round up votes for a quorum, I guess the cash is, paying shareholders for that's not a whole lot different than giving them a tote bag full of stuff. But in a controversial situation, if you're trying to sort of direct, and there was one case, I think Hewlett Packard was a big case in where I think it was Carly Fiorina was trying to get the compact deal done. And started making promises to compensate some big shareholders to vote for her or vote for her version of the deal. And I think that got on the wrong side of one of the chancellors. Yeah. Is my recollection. Yeah.
See, that's the thing that that Delaware would again draw a distinction between not undermining the shareholder franchise, like trying to get a quorum is probably on the right side of things, and there have been some other cases where it was just weird, that the corporate resources needed to be expended but it wasn't trying to undermine the vote. But that's very different than trying to essentially swing a proxy contest, which would undermine the franchise, and that's probably and that's definitely going to be, I think, a very real line.
Right. So there's a whole separate discussion worth having in a little bit of time that we have here about whether, let's suppose that some of the things we say we think are legal, in fact, would be legal. That it's legal for one shareholder to buy votes from another, and it's not really legal for, at least in and I only care about proxy contests. I don't really care about quorum at most companies. That's in my view, that's the company's problem. If they can't figure out who their shareholders are and can't persuade them to show up in a meeting, they got bigger problems. The other interesting aspect of this that shareholder vote exchange and I've also thought about is what kind of disclosure obligations exist. And that's not really clear either. So if I were a shareholder and I were in a proxy contest and I were an activist buying shares from buying votes, from another shareholder, what do I have to disclose about that activity? And that's really interesting, and that's very unclear. First, I believe that's a matter of SEC regulation.
Yeah, I would assume that you would form, if you hit the percentage, the 5% line where you have to disclose, if I had a contract with you that you would vote your shares the way I instructed because I gave you money, we would presumably be forming a group, and there would have to be some kind of 5% disclosure. I think the SEC is...
Potentially. But on the other hand, and again, this is all indeterminate. There's really, SEC I don't think has ever come up with any kind of advice in here. But I'm curious whether that act, the act of compensating a shareholder for their votes, in fact is the act of soliciting votes.
Oh, that's interesting.
And not necessarily the act of forming a group. Because soliciting is very specifically not covered by 13D form 13D disclosure and so forth. Otherwise, every time.
But there are lots of rules though about if you're soliciting votes, there are a lot of rules about filing proxy statements.
Absolutely,
and all other kinds
right. But the actual act of compensating, because every time
the act of actual compensating
is possibly considered solicitation. And not something else, not group formation. Because, look, going back to my earlier anecdote about how, rather than jumping up and down in front of a shareholder with my proxy solicitor trying to persuade them, if I just gave money, Okay, every time my proxy solicitor succeeds in attracting a vote from
Yeah.
another shareholder, they're not part of my group.
Well,
We're just soliciting.
it might be because
right?
but even because a contract to vote a certain way again might count as forming a group. But even if it's not, even if it's a solicitation, there's a lot of rules about disclosure about
absolutely.
solicitation.
Right,
So then you would still end up disclosing. It would be a different kind of disclosure.
The how I solicit and who my proxy solicitors and the proxy materials I have to file and so on and so forth. That's absolutely, those are all very well regulated. But then the open question is whether the act of buying votes is squarely within the definition of what it means to actually do the soliciting, or whether it's something else. And I don't know. And we're going to have to think about that.
I would be really, I think the SEC, at least this SEC, we'll see what happens when the Trump administration takes over. This SEC tends to take as broad a view of its authority as possible. So
yes.
But I mean, the other thing that I'll mention about this issue that makes it complicated is that there are a lot of things you can do to buy votes that aren't buying votes. And that creates the problem because, like, why do you draw the line here rather than there? So there's buying votes, which shareholder showed exchanges is like literally paying money for votes. But but what you can do very easily is borrow shares.
Sure,
and
you're going to the share lending. You don't need, or how about borrowing shares and not short selling them? Just borrow them.
Yeah, you could just borrow them, and then you have the votes. And then this has come up before. So like for example, there's a very famous case where there was an activist shareholder that held shares in a Target company, and for the merger, and they wanted the merger to go through because of their Target holdings. So they borrowed shares of the acquirer so that they could vote the shares. Or I think actually no, they didn't. They might have bought the shares, but then like got rid of all the economic interest with various derivatives solely for the purpose of voting.
To support the merger, right? Exactly.
To support the merger that was not going to be great for the acquirer. They wanted it because they want it on the Target side. So there are a zillion different ways you can use derivatives to functionally get rid of your financial interest in the company and still have
keep
the
votes.
And so the question is like, well, why should we prohibit like this kind versus that kind? Or like, shouldn't we have it just sort of grand theory of economic interest tied to the shares? But it's very hard to do.
Right. So anyway, so this is there's a future for this. I am convinced.
Okay.
Now that shareholder vote exchange is no longer around to actually facilitate a marketplace in transactions, I foresee there will be, like, so to speak, off-market transactions.
Yeah, that's
where,
possibly true.
Where I could, get my proxy solicitor, or I could, just myself go to shareholders and say, just one by one, negotiate deals with big block holders and say, how much for your shares? And assuming I can get comfortable, I think it's legal to do that.
It might be legal, but again, I still think you're going to end up you're going to run into 13D trouble.
Yeah, right, exactly. Whether I have to disclose that activity is a different story, and that sets aside completely the optics.
Yeah.
The idea of it makes people uncomfortable.
At the very least, like, unless you're planning on literally getting to a majority that way, all the other shareholders who you haven't bought, if they vote at all, are going to be thinking, like, wait, why does he have to pay money specifically for this? This can't be a good transaction.
Right.
Yeah.
Yeah. So there's an interesting little order of events where, maybe I've persuaded through my solicitor, 45% of the votes I need, I'm making that number up, to vote for me, and then I just need that next 5%. I start paying money for that 5%. The first 45% are going to wonder, where's mine? Where's mine? Exactly.
Yeah, how much money are you planning on making on this that it's worth it for you? Wait a minute, so exactly.
So there's some very delicious strategic and tactical nuance that needs to be worked out here. But it's a fascinating legal and economic situation. I actually set up a company to try to do this at one point. It's called Unbundle X. And we have other things. We took it in other directions at this point, but there's a whole little venture I started with some friends.
Come back to it.
we were going to create an exchange originally, but then shareholder vote exchange kind of got going, so we moved on to some other stuff. But if we can talk about Unbundle X at some other point in time.
Okay.
So anyway, so that's what I've been thinking about. Isn't that fun?
Yeah, it's a fun puzzle. It's puzzled academics for quite a while, but
Oh yes, absolutely.
yeah. All right, well, let's wrap up there, and there's more we'll cover next time.
Yes, indeed, we will. So, thanks, Ann. It's been terrific kind of covering what flavors of Ben & Jerry we like and how much of our vote bang we have to disclose. This is Shareholder Primacy, hosted by Ann Lipton and me, Mike Levin. I'm an independent activist investor and advisor to investors about their activist situations. Ann is the Michael M. Fleischman Professor in Business Law and Entrepreneurship at Tulane Law School and an affiliate of Tulane's Murphy Institute. You can find me, Mike, at theactivistinvestor.com and Ann at law.tulane.edu. Our podcast, as always, is produced and distributed by Free Float Media. Thanks for listening, and we will talk again soon.